name is Sonya Wong, and I'm a partner at QX Financial, and I'd like to welcome Phil Shekerlian to our channel today. Phil is an estate attorney who has been a wonderful resource for QX Financial, and today we're going to be talking about partnerships and sole proprietorships and conversion to various entities. Or actually, I think the correct term to use is elections, right? Instead of
Absolutely. Yes.
entities.
And thank you for having me again, Sonia. We wrapped up our last video with talking about the first type of pass-through entity, which was an S election. And remember, that could be on an LLC or a corporation only. So the next type of tax election that you can have that's a pass-through is a partnership. Now, this is the default on an LLC. If you form an LLC with the state of California or any other state in the nation, and you do not file any additional tax election paperwork with the IRS, you are automatically considered a partnership. That's assuming that you have one or more, or you have more than one owner. If you only have one owner, then you're automatically considered a disregarded entity or a sole proprietorship. But a partnership, which is probably one of the more common ones out there, is good for a lot of things. So let me talk more in detail about how they're formed. So the first is, like I said, you have to have two or more owners to have a partnership. Can't have a partnership without a partner. Once again, just like an S election or a C elect, or I'm sorry, unlike an S election or a C election, the owners are not treated as employees of the company. That's an important distinction because of what we talked about in the last video, which was the ability to pay dividends versus a reasonable salary. And because you're not an employee, there is no reasonable salary requirement. Therefore, all the income is subject to the self-employment tax. To file the tax return for a partnership, whether it's a LLC or just a general partnership filed with the state, you would file a Form 1065 with the IRS. And then just like with the S election, there would be a K-1 issued from the 1065 to the partner's personal 1040 tax returns that would report the income. So again, all the income passes through directly to the partners, and the loss as well. Once again, you could write off that loss just like you could with the S election. The big benefit to doing a partnership is that, well, there's a couple benefits. One is it's a little bit easier than an S election to deal with, but the biggest benefit is the step up in basis that I left off with on the last video. So once again, the step up in basis means that when you die, any asset you have that's capitally appreciated steps up to its fair market value, and all capital gains owed before that is all erased. So why is that important? Well, I have a lot of clients, good majority of my clients that have business entities have it for one reason and one reason only, and that is for asset protection for real estate that they own, rental real estate. So if you put your rental real estate into a LLC or corporation, whatever, with a C election or an S election, and you are the sole owner of that, or you and your wife own it, or you and your husband, whatever the case may be, and you die, then that real estate does not get a step up in basis inside that S election or C election. But if you open up an LLC, put that real estate into the LLC, and then leave it as taxed as a partnership, and husband dies, wife dies, both of them die, whatever the case may be, that real estate will get a step up to the full market value. So what that means is, let's say you bought the property for $100,000, the real estate, put it into the LLC, and then one of the owners dies and it's worth $1 million. The kids of the owners decide to sell it right after the owners die. Rather than the kids owing capital gains tax on $900,000 in gain, they owe zero capital gains tax because the new basis for the kids is that $1 million rather than the $100,000. So this is where I see a lot of problems. A lot of CPAs, enrolled agents, a lot of people that consider themselves financial experts that are helping clients, they constantly say, oh, you have a rental real estate, you could be sued, you need to protect yourself. I'll set up an LLC for you and put the real estate in there. But then they set it up as an S election so that they can have some tax benefits, not realizing that they lose the step up in basis. And that's terrible for most clients. The amount of taxes paid on a rental real estate in an S election versus a partnership are going to be so minuscule compared to the loss of the step up in basis at the death. It's really a malpractice for people to be recommending an S election on that. So then that's the biggest benefit to the partnership. Well, actually, there's really not a whole lot more benefits. That's the benefit itself. There are some disadvantages, though.
Yeah.
employee benefits are not available to straight partnerships. So if you set up an LLC with a partnership election, you may be able to get health insurance, death insurance, life insurance, things like that. Or you may not. Some carriers out there really require that you have a corporate type election. Not a corporation, but a corporate type election. If you don't even have an LLC and you just have a straight general partnership set up with the state, then you're really going to have a hard time getting a lot of the benefits. There, a lot of carriers do not provide benefits to non-LLCs or corporations. Other than that, it's really pretty much the same as an S election for deductions and for some of the tax advantages. Once again, one thing to keep in mind, we talked about asset protection in one of the prior videos. If you set up a general partnership and put assets in there, there is no asset protection. But if you set up an LLC, put the asset in there and tax it as a partnership, then you have the best of the pass-through taxation and you have the asset protection as well. So make sure that, once again, you seek a professional attorney on this one to decide whether or not you should have a general partnership, LLC, or what your tax election should be. The last type of pass-through entity is either what's considered a sole proprietor or a disregarded entity. So if you set up a LLC and you don't have partners, then you're a disregarded entity and all the income just passes straight through. Works a lot like a partnership. You still get the step up in basis, you get the same deductions, but you don't have to file a separate tax return. You don't have to do the 1065 or the 1120 or any of those returns. The owner files the taxes directly on their 1040 on Schedule E. And so that's where all the income and the deductions and things show up. Something to know is that in a state like California, we're considered a community property state. There's, I think, like 30 or so community property states. In a community property state, you could have a husband and wife as joint owners, and it doesn't have to be a partnership. It can be a disregarded entity because under a community property state, husband and wife are treated as one individual anyhow. So that's something that you could do.
Is the term single member LLC also used for these types of organizations?
Absolutely, yes. This one would be what's considered a single member LLC. So those are the types of tax elections you can have on a business. Now you can set up your business and convert. If you started off with a C election, you could convert to an S election or a single member or something along those lines, or a partnership. But the downside to that is because a C election holds the assets inside there, there would be something called a built-in gains tax upon conversion from C to one of those other elections. And essentially what that built-in gains tax says, well, anything that's left over inside the corporation that already hasn't been distributed on the owner's tax returns needs to pay taxes still. And so when it converts, you pay taxes at that time. So that could be a big tax bill if you convert from a C to a pass-through type election. So you really want to consult with probably both your attorney and your CPA on that one to make sure that you're not going to get an unexpected tax bill. The other direction, you could convert from an S election to a C election. You wouldn't have that big tax bill, but you do have to file the proper paperwork to do so. And then you could also convert from a partnership or sole prop to an S election or a C election or whatever by filing the same paperwork as well. And you would not have that big tax bill.
Yeah, I can see, how there could be so many complexities, and anyone considering starting a business should definitely think it through and have a team, someone like you, an estate attorney, as well as their CPA.
Absolutely.
Yeah. So I want to thank you for sharing that great knowledge with QX Financial and its viewers. I'm sure that we'll probably get plenty of questions and people wanting to get ideas from us. So I want to thank everyone for viewing. And then also don't forget to like, share, and comment below. Thank you,
for
Phil.
having me.